In this chapter, we take a closer look at liabilities. We're going to review different types of liabilities and then look at some different accounting for them, especially bonds. So, as we get into this, some of this again is just a review of what you already know, but make sure you go through, define the difference between current and long term, and understand what a notes payable is. As we went through the chapter on receivables, a lot of this is going to look familiar. We're just looking at the other side of it now for payables. So that first entry that we want to know, when we issue a note payable, we're going to debit that cash and credit our notes payable. Again, the difference between an account payable and a note payable is the fact that there's interest. So we need to remember how to calculate that interest on a note. We're going to take the principal of the note, or the face value of that note. We're going to times it by whatever rate they give us. And typically this is given in an annual rate. And therefore we're going to multiply that by the time we hold the note for. And that will tell us what the interest is. When we want to record that interest expense, typically we'll record interest expense as a debit. And then most of the time, depending on the due date, we're probably going to record a credit to interest payable. If we do pay it immediately, then it would be to cash. So if we did accrue some of that interest payable, and then we're going to pay it at when that note becomes due, first thing we're going to do is write off the entire note with a debit to notes payable, and that's for that full amount. We'll debit that interest payable if we had accrued the interest already. If we have not accrued the interest, then this would be to interest expense. And then finally, the cash is credited for the sum of those two amounts. Again, most of that should be kind of a review. And then we'll get into sales tax payable. We all are pretty aware of what a sales tax is. We pay it every time we go buy anything. So we're going to go ahead and debit that cash. We're going to credit our sales revenue. And this is basically for the price tag amount, I like to say. And then we're going to credit our sales tax payable. Because remember, these companies are collecting that tax from you. They still owe that tax, and they're going to pay all of that cash. To compute the sales based on total receipts, if we take our total receipt, or the total amount we're getting, we divide that by 1 plus whatever our rate is, and then that's going to give us what our sales amount should be. So let me explain this to you. So let's say our total price we have to pay, or our cash amount, was $5.50. Around here our sales tax is 10%. So if our rate was 10%, then we would divide that 150 by 1.10, and that would mean that our sales, or that price tag amount, was $500. It's just a way of looking at it depending on what pieces that you're given to show either your total receipts or your sales. Another liability that we'll talk about is unearned revenue. Again, this should be our review. We went through this a couple of chapters ago. When we receive cash, we debit that cash, credit the unearned revenue, and then once we perform the service or do what we're supposed to do, provide what we're supposed to provide, we'll debit the unearned revenue to decrease the amount of our liability and credit our revenue once we have incurred it or it has been earned. So one other thing, just go ahead and make sure you define that long-term debt section of the balance sheet where it belongs. Know a little bit more about that, but we're going to spend some time here on our payroll. And it's kind of printed funny, sorry about that. But to record your payroll expense, you're going to go ahead and debit that salary and wage expense. That's your debit. And then you're going to credit each of those payables that relate to the payroll taxes. You're not going to need to know how to calculate these things. That's fine. They're going to give you these amounts. You're just going to have to know how to record the payable related to them. So we have FICA, we have our federal income tax. Again, all payables, so they're credit amounts. We have our state income tax. And finally, we have the rest of it is going to our salaries. Wage payable. So if I put this in your perspective, this is the amount of your paycheck, right? That's the amount that you're actually getting in your paycheck. The employer's taking all of these amounts out of it and holding it on to give to the appropriate governmental agency, but the company's also recognizing the entire amount as an expense. So when we go ahead and we're going to pay just the payroll portion of that, we would debit our salaries payable. And credit that cash. That's for the salary piece of it. And we're going to have to go ahead and record the other pieces. Remember, when we talk about our federal and state income taxes, this whole piece here, this is the portion that the employee is getting out of their check. There's another portion of it that the employer has to pay. So we need to record that part as well. That's our payroll tax expense. And then we'll record the FICA and federal and state. Federal income tax payable. Twice. And the last one is that state income tax payable. So remember, although these two journal entries here and here look the same, this one has the employee contributions, this one has the employer contributions. So we do need both of them. And finally, the big part of this chapter is bonds. There's a variety of different bonds that you can buy. So make sure you go through and define what each of these things are as it relates to bonds. What a bond is a way for a corporation to raise money without giving up control. We'll talk about stocks in a later chapter, but this is a way that they can raise funds without giving up control. Bonds are sold on the open market. You can go ahead and buy a bond if you have an extra, $100,000 of cash laying around somewhere. And then the benefit of the bonds is that you're going to get interest in all that money back if you invest in a bond. So understand bonds, what they are, the types of bonds, and some of the definitions that go along with that. What we want to focus on in this video is recording the bonds and how to calculate the bonds. So the first thing I'm going to focus on is the bond price. Because bonds are sold on the open market, that means that the amount of the bond that it's selling for is not always the amount that you're paying. So we're going to take that face value of the bond, or the par value, multiply that by the quoted price. This is usually given as either a percentage or a 0.97 or just even 97%. And that's going to give you your cash proceeds, or how much money you're getting in exchange for these bonds. That'll make a little bit more sense as we go through some of these journal entries. So let's just say that we're going to record just the sale of the bond at face value, meaning it's sold for what it's worth. If a bond is $100,000, I'm getting $100,000. I'm going to debit my cash, credit that bond's payable. It's a liability. I have to pay that back at a given date. Bonds do accrue interest, so we'll have to make sure we accrue interest as needed. So we debit our interest expense, credit that interest payable, and then again, to calculate the interest, we're taking that face value or the principal of the bond, times it by that annual rate, and that's going to give us our annual interest. So very similar to your notes payable journal entries, but you remember those bonds payable sold on the open market with stocks and everything else. So you'll see where these differences come in. Finally, we have to go ahead and pay that interest. We'll debit the interest payable and credit our cash. Now we have to understand the difference between a premium and a discount on a bond. A premium bond is their cash proceeds, the amount that they're getting for the bond is higher than face value. Whereas a discount, your cash proceeds, the amount they're getting for the bond is lower than face value. And again, this is because of the market fluctuations. So if I'm selling a bond and I'm going to put it out there for $100,000, that doesn't mean that that person's going to spend $100,000 to get it. It all depends on what the market is doing. But I still have to pay back that full face value. So we'll show you what that looks like. So again, this is a discount example. If I'm recording bonds at a discount, I record the fact that I got cash. I'm going to credit my bonds payable. And the difference is going to go to the discount on bonds payable as a debit. I'll throw some numbers in here just to give you an example. If I have 100, we're just going to use simple numbers. 100, we'll give it a $100,000 bond. It's selling at 97. So that means my cash proceeds are $970,000. Oops, too many zeros. Let me do that again. So my bonds payable is still 100,000. The cash I'm getting is 997. That means I'm going to have a discount of $3,000 on that bond. And then we can go ahead and make sure we understand the cost of borrowing. And this has to do with the interest. So if I take my annual interest, all those payments, and remember we showed you how to calculate that interest up here. That face value times the annual interest rate equals the annual interest. We're going to take the annual interest payments plus my bond discount, and that's going to equal the total cost of borrowing this money. Because remember, I still have to pay back that full $100,000. So what happens if we sell at a premium? We're getting cash. We're still recording that bonds payable. But here we're going to record the premium on bonds payable. So what happens here, again, we'll give you a little quick example. Let's say it's selling at 102, which means we're getting $102,000 for this bond. Our cash is at 102,000. I still only have to pay back that 100,000, and that premium is recorded for the difference. Therefore, when I'm calculating the total cost of borrowing here, because it's selling at a premium, I'm still looking at that annual, the annual interest payments. This time I'm subtracting that premium to give me the total cost of borrowing. And finally, redeeming the bonds just means, you're paying them off. So you're going to record that debit to your bonds payable and credit to cash. At times, depending on what type of bond you have, you might want to pay it off before its maturity date. If that's the case, you have to figure out how much is that carrying value of the bond and eliminate that. So we're going to eliminate the carrying value. And we'll show you how to do this in those journal entries. The carrying value is that bonds payable, and getting rid of that and recording the difference in the premium or discount that you have. Next, we're going to record the cash received. or cash paid, sorry. And finally, then we can recognize step 3, recognize the gain or loss. So again, that carrying value, that's looking at your face value of the bond. You're going to subtract any remaining bond discount, or you're going to add back any premium. And that's going to give you the carrying value, because we want to make sure that both that face value of the bond and that bond premium or discount are eliminated from the books. So kind of like think about your closing entries. We're getting rid of the bond payable, which has a normal credit balance. So we're going to debit that bond payable. This is part of the first step. We're going to get rid of that premium or discount. Get those off the books. Remember, this is going to give us that, eliminate that carrying value by getting rid of both of those things. And depending on if you have a premium or discount is going to depend on if it's a debit or credit. If you recall up here, when we recorded the discount, we have a debit, a premium as a credit. Therefore, if I wanted to get rid of them, that premium is going to be debited here, or the remainder of it, and the discount is going to be credited. Then we're going to record in step 2, which is record the cash that's paid. So I'm going to credit my cash, and the difference is going to be a loss. Oops. And then the difference between my debits and my credits here between steps 1 and step 2 is to record that loss or gain on bond redemption. Again, if I have a loss, it's going to be a debit. A gain is going to be a credit. And we just fill that where we need to, because your debits have to equal your credits. And then finally, we'll talk a little bit more about some long-term notes payable, such as a mortgage. So go ahead and define what a mortgage is. Again, you're debiting your cash, crediting your mortgage payable. They're not going to give you a mortgage without charging you interest. So when we pay that installment for our mortgage every month or whatever it is, you're going to debit that interest expense, lower the amount of your mortgage liability, and then credit our cash. And then we'll talk about a lease. For a lease, again, the printing on this didn't go as planned, sorry about that. But for a lease, we're going to go ahead and record a lease as a right of use asset. That's what we call that, and then we record that lease liability. And finally, just some equations to memorize, or not memorize, but to know, be aware of. So you might want to record some of these in here so you have those formulas. There's a big appendix to this chapter. Just know that you do not have to understand the appendix in this chapter, just the stuff that's provided here. But if you do have questions, please let me know.